G'day everybody. This week's Scale HQ podcast, I have such a great guest lined up for you. I'm chatting with Terry Tran, who is like a former fund manager and founder of The Freedom Trader, where he teaches people about stock investing, share investing as one of the asset classes that you can use to build wealth. Obviously, I spend a lot of time on the business and how you maximize the opportunity in your business. There's other people that talk about property. Today, I brought Terry on to talk about stocks because I've been really impressed with the level of transparency and authenticity that he has in the way that he teaches. And I'll explain that. So he's been in the market for like 30 years. He is a former fund manager and he's helped more than 1,600 people so far to figure out how to grow their wealth outside their business using share trading as one of the vehicles. And he's not a day trader, by the way, just let's have that up front. He's a value-based investor. He's got some really unique ways of the way he teaches. And that's exactly why I wanted to have this conversation because, sometimes like we double down on, we put all the wealth eggs in the business basket. And, we might even be reinvesting every single dollar of EBITDA to grow our bottom line and grow our top line to try to get some future exit. Now, exits, of course, are a great thing to do if that's what you really want and that's the best outcome for you, but they're also not a given. You could be ready to exit at a time where actually the market is not interested in your kind of business, or there's a recession, or there's a million things that can go wrong in terms of, planning and timing an exit. But sometimes we are trying to figure out, we compound the risk or the concentration risk of like everything is reliant on the business for our future wealth. So, you might have a business and all your kind of eggs are in that basket, all your reinvestments going into there. And maybe you've got a property or a couple of properties, but actually that's all you've got. Maybe even one of those properties is your business property and it's in your self-managed super fund, which actually even further compounds the concentration risk. And I know that lots of founders, myself included, default to property as the go-to investment strategy because it feels safe. It feels, it feels tangible. But there are, of course, also a whole bunch of other downsides that some of us don't think about, especially when we're trying to build something that gives us, freedom in the long run. So, if you're at the stage where you're maybe like 35 to 55 and you're thinking, how do I make sure I've got the best financial outcome in the future? What is the right level of kind of liquidity in my portfolio? How much should I have in shares? How much should be in my business? And what about property? How much should I have? How do I make sure that when, if you've just watched all of the disruption happening with Trump, you're probably thinking, geez, I had a whole bunch of cash liquid and an investment strategy that I believe in rather than just guessing. So I'd know which stocks to buy because the markets have taken a dip, but it's probably a temporary one. And so there's probably been some amazing buying opportunities that you've missed out on. I have too. Terry takes a bit of a different approach. And I think the thing I love about him most is he's massive on transparency. So as he teaches his students on how to invest, he shares his own share trades every week, what he's buying, what he's selling, and he has visibly available at all times his portfolio, the amount of money in his portfolio, the returns on his portfolio. So he trades along with his students. His students are following along his trading strategy. And again, it's not day trading. It's not like in and out in a day. He's value-based investing. He's buying businesses, pieces of a business with the intention of holding them. Now, it might only be for weeks. It might be for months. It might be for years. It's actually opportunistic purchasing of quality businesses at the right price. So today is, if you're super heavy on business, if you're super heavy in property and you've never really given much thought to shares or you don't have much of a strategy, I think you'll really enjoy the conversation that I have with Terry today. It might open your mind to it. It's certainly opened my mind to it. And I only ever invest in things that I know and understand. And who knows, maybe I'll become a student of Terry's as part of my portfolio building for the future. I think probably I will. Anyway, if you're trying to think about how to optimize, the asset classes to make sure you get the best possible outcome in the future, I'd suggest you listen right to the end, not only for the conversation, but Terry's got some amazing resources that he shares at the end. You're going to love those. So hang on for the ride, enjoy the conversation, and welcome Terry Tran.
Welcome to the Scale HQ podcast. I am Sean Steele, and I'm a growth mentor, digital nomad, a massive metalhead, and the founder of Scale HQ. And you, more importantly, are a founder of a 7 or 8 figure services business who is finally ready to get serious about scaling up or securing a step back from your business or a life-changing exit in the next 3 to 5 years. And if that's you, then you are in the right place, because with over 100 million in revenue growth across my last 4 companies and many acquisitions under my belt, I have spent my whole career figuring out what makes businesses more valuable, scalable, and sellable. And I've learned a couple of things, and I'm thrilled to have an opportunity to share those with you today. So welcome to your fortnightly dose of practical strategy, founder success stories, and expert deep dives to help you finally get a return on all that sacrifice that you've made in your business. Welcome to the show. Let's dive right in.
G'day, everybody, and welcome back to the Scale HQ podcast. I am so excited about this conversation. I have been looking forward to it for ages. My guest today is Terry Tran from the Freedom Trader. Terry, you've been a fund manager. You're a fund manager for 15 years. You've been 30 years in the financial markets industry, and I am a self-confessed property guy who's done a lot in property and sweet bugger all in anything outside, ETFs and index funds for quite a long time. Notwithstanding, I have been co-investing and teaching my boys about compounding interest since they were very young. They've both got share portfolios. They both continue to invest, but never no stock picking whatsoever, just all kind of ETFs and stuff. So I always think, you invest in things that you understand.
For sure.
And I've taken the time to understand property. I haven't taken the time to understand, stocks or trading. And so, if you are keen to step your business up to the next level, like by taking on an investor or stepping back and installing management so that you can enjoy dividends and get out of operations, or perhaps you want to secure a life-changing exit in the next 5 years in your business, well, whichever one of those three things you want, you are going to have to really think about what you prioritize over the next few years, because it's going to matter a lot as to whether you actually achieve those or not. And that's why you're going to love my Scale Scorecard that I've developed. It is a new diagnostic tool which I'm making available for free so that you can figure out where you're at right now and what you should focus on next. But it is not some made-up fluff that I read in a book. This is real-world scaling, investments, exits. If you would like to maximize your chance of securing that step up or the step back or the step out, then come and find out your Scale Score at scalescorecard.com.au and click the button to take the quiz. I guess a big part of our conversation today is, I spend a lot of time with these founders with $3 to $30 million businesses. Some of them have got fantastic dividends. And I'm always thinking in the background, it's not really my job to get involved in it, but I'm always thinking how much of their future wealth or generational wealth or retirement is based on them either getting an exit, relying on dividends, or can they be building wealth along the way? Like, are they building wealth along the way rather than waiting for some golden rainbow? And of course, there's lots of different ways you can deploy your capital to grow wealth. And I'm super interested to learn from you today for the benefit of all the founders who might be listening, given you've been helping people create wealth for a very long time and at quite a scale. So welcome to the show today. Great to have you, mate.
No, thank you, Sean. Thank you for having me. And great to share what I know and hopefully bring you to the other side of the world as well.
Perfect. Well, maybe we can start with, in my mind, almost the most fundamental question, which is why do business owners, Sean included, default to property for wealth building? Why is it seems to be almost like the default setting. What is going on there, and what are they kind of missing out on?
I would probably say it's comfort is the big word, because obviously they've grown up, in their own house. They've seen their parents. So it's almost like a cultural thing. Especially even in the Asian community, the parents always say you must buy your own house and don't ever rent from people because it's dead money type thing. So it's that cultural and generational, pass down of that knowledge. But I think the other thing too is, of course, as you're driving, to work, from work, etc., you're seeing houses, you're seeing properties, etc., pretty much day in, day out. So the tangible nature of it gives you that there's something to hold on to. And if ever you feel like, you're not comfortable with it, you just go there and stare at the house and know that you actually physically own something that you can touch and feel. And of course, if you lease it out, there's someone living there paying you a rent, and there's income from that as well. So I think that's the main thing. And the other thing too is, obviously especially our Aussie banks, they love them. So you can easily get finance. Of course, these days, much harder now because you do have to save a much bigger deposit, whether it's commercial or residential, because the properties are quite expensive now. But the banks do like it, and therefore allows business owners to leverage up and borrow quite a significant amount, and then start from where they are with a bit of equity, and then just scale up from that point of. But
I remember when I was 20, I think I bought early 20s, I bought my first property, and I think I got a 105% loan.
Oh.
It was the days of significant leverage.
Yeah. I mean, when I used to work with the bank, as being a staff member, you could borrow 90 to 95% lend.
Yeah.
And that was amazing because you as a staff member, back then I didn't earn very much, but to borrow that amount was ridiculous. You didn't have to save that 20%, even though properties were way cheaper back then as well.
That's true. And I remember coming home to Anna, who we weren't married yet at the time. We were close to, we were engaged. And I remember saying, this is how much the bank, I can't remember what the number was, but it was like, I don't know, $1 million or something. Like, this is how much the bank is willing to lend me. I was like, I cannot believe that they are willing to lend me this much money, because there's no way that I can pay that back. Like, they know what my salary is. They know how much my disposable income should be. How could I ever pay a loan back? Why are they offering me so much money? I was so confused about the process. I mean, those days are probably, maybe, hopefully, a little bit behind us in terms of the amount of leverage. But clearly, that's one of the big differences, right? Is the leverage side. Notwithstanding, you can get margin loans for shares, but it's far more typical that you're theoretically controlling a bigger asset value with a smaller amount of money. But of course, therefore, you're also compounding risk and so on.
Yeah. And then I think the other thing too, Sean, is tax advantages. There's always seminars out there that talk about negative gearing and stuff like that, and why pay so much tax when you can have the government help you pay part of it and have depreciation benefits and things like that. So I think it's just that the combination of all those factors allows people to go, yeah, property is my first choice, literally.
Yeah. Yeah, makes sense. I guess when people are comparing kind of property and stock trading or share trading or kind of, investing businesses, they're often, the sort of default comparison is the growth rate, right? It's like, well, historical growth rates in property are, 8%, and in stocks they're 9%, or you'll talk to a property person, they'll say it's 9% for property and shares are 8%, and you talk to somebody in shares and they're like, oh no, it's 12% and it's not, anyway, whatever. But it only ever seems to be around the one metric, which is like the kind of compound annual growth rate. But clearly, there are costs, there are tax implications, there are a whole bunch of other things that there are fees that all eat into these returns and can materially change it. Like, what, from your perspective, what are the hidden costs sometimes that maybe aren't considered in property versus share trading?
Yeah, there's a lot. I mean, one of the big benefits, definitely, even without talking about costs, is firstly diversification, like risk management straight away. Like stocks will, basically say a $20,000 or even $50,000 portfolio of that size. You could not even buy, literally, you could not even buy a laundry room with that amount of money these days. But whereas with stocks, with even that amount, that diversification allows you to even own 20 or 30 listed companies out on the market with even that small amount. So that's one of the big considerations. But then when we go into the cost side, there is, as we all know, when we get into property, there's, to get in it, there is a lot of, say, even stamp duty. The amount of stamp duty that we have to pay just to get into, of course, it does vary state by state and also where you live. But stamp duty is a big one. Then on top of that, even though you get the weekly rent or whatever it may be, the monthly rent, and then when you take away, from, say, agent fees, that's part of it, and then down a track, if you were to sell it, the amount of agent fees that you'll be selling, to pay to also sell the place is also quite a large amount as well. So people don't see that because it's sort of almost like they feel like it's passive, and all those other hidden costs, and especially when properties go old. What I found, I have owned property as well. What I found is like things do break down, and all of a sudden, this is broken, that's broken, and then setting plumbers, electricians, etc. They all eat into it, but yet it's not seen because in the end, the agent takes care of it. And you give them the discretion, they give you a yes or no, and you just go yes, and then they take care of it. And at the end of the day, as long as sort of the rent pays for it. But then in terms of that, if you look at the net result, what it actually is, probably a big sort of drawback compared to, say, stocks, which really don't have much costs. Get into it, wholesale brokering, $1 or $2 to get in, $1 or $2 to get out, and then even stamp duty is hardly anything as well. So yeah, and then ongoing management fee, there is pretty much none, unless of course you've got an advisor that looks after your portfolio. Then that's different. But if you're self-managing it properly, there's not much cost from that point of view as well, and there's nothing will ever break down, so to speak, too.
Yeah, it's true. And I guess one of the other costs that is, I guess one of the major property costs is your interest cost, right? Which on the one hand, of course, you might have a fixed period if you're willing to gamble on a fixed period, but of course you're paying a higher interest rate, and so the differential between the two might take quite a few years before they sort of balance each other out. And then on the flip side, you're kind of course, you're hoping and praying that your interest rates aren't going to go up, but all of a sudden, if you have a property that might be, let's say it's close to cash flow neutral, then I remember in the COVID period when everybody was locking in at super low rates, and 3 years later when they came off, they were like 2 or 3 times the same. Like people's mortgages were like doubling and tripling on the end of those periods, which can completely derail the game if you have over leverage, if you don't have enough disposable income to cater for how you kind of done your calculations on the interest rate, or if you've lost a job in between, or your business has gone south or whatever, can be tricky.
Yeah, and then there's also, Sean, the vacancy. This is assuming everything goes right. And then there's that vacant, there's people either in residential or commercial. But as you know, once they leave or they don't pay rent, almost becomes a domino effect. Because I've had that happen in the past where I had multiple properties, but did I really own it? No, it was the banks that owned it. I owned the slither of the equity. But then one of them did not pay rent and ended up the agent taking them to court, and it took pretty much at least 6 to 9 months. And then insurance ultimately paid it out, but it was a 6 to 9 month period where there was really no rent coming in, and it was just dragged through the courts, etc. And then I did think to myself, that was just one property. But what if I had another one that had the same thing? I would have had a lot of issues on the financial front. And then I realized, it's almost like a domino effect, that one domino could top another as well. So that was my sort of first taste of, when things do go wrong. And yeah, so there are a lot of, I guess, risk, but also the hidden costs that people just don't see as well.
I think there's probably also a I mean, this sounds like I'm jumping on the bandwagon, and I'm not saying that you're bagging property, but we're just we're trying to be transparent about there's no, exactly. And I know that that's not yours. So I'll come back to that. I think one of the things that people often think about property is that it's a set and forget, it's super passive and all the rest. But if you're actually building a portfolio and you've got 3, 4, 5, 6, 10, 15 properties, and not many people get into the 15s, like not many people usually get past sort of 2 or 3, but you absolutely have to manage those actively. Like you may have agents involved, but there is absolutely, hours per month of administration, of back and forth. Like it might be scattered throughout the month. You need to be doing your financials every month. You need to constantly be looking at interest rates and do I have the right loans and what's happening with those tenants and what's the maintenance plan. And it is very much an active investment. So I think anyone who's getting into the mindset of this is that property investment is set and forget is probably a little bit misguided too.
Yeah. And like you said, Short, I think, when you have, and I personally, like you said, I'm not bagging property. I do believe, one should have and own their own house. So at least you've got a place to stay and it's solid. You're never pushed to move out at any point in time, especially if you've got a family, etc. And then when you have, a couple of investment properties, there's no issues there. It's only, like you said, once you get over, I would say, once you get over the 5 mark, that is when you go, oh, wow, then now you've got multiple properties, multiple agents you deal with, multiple tenants that have things breaking down and agents constantly contacting you. So that's when things start piling up without you knowing. And having 1 or 2, you don't really feel it until that. And that's how I felt it too. Once I had the multiples way above 5, I actually even had 10 at one stage as well. And then that's when things started realizing, am I really free time-wise? Probably not.
Yeah, it's interesting. It's always hard to know how much of it comes down to property selection. There's a bit of luck. There's a bit of diversification. There's a whole bunch of sort of mixed in factors. When I had, prior to leaving Australia, where I had 6 properties in tandem, it didn't really take me that long, but there was definitely administration. There was definitely having to stay on top of things. And I think when you stay on top of things in property and you manage it actively, you can definitely minimize the sort of problematic nature, and you can, of course, diversify by state and property type and much rather not the same level of diversification I think that you can get in a portfolio, in a shares portfolio. But I did think it was manageable, but I reckon there was also a fair bit to do with the buyer's agent support that I had. And therefore, the sort of strategic support I had to look at, we would sit down every quarter and look at the portfolio together and go, okay, let's think about how this is optimized. Let's think about all the interest rates. Let's think about all the rents. And so it actually kind of forced good proactivity in the portfolio, which I think reduced a lot of problems. But often people are doing it on their own, and then it can become a bit sort of unwieldy, and you're still learning everything yourself, and you don't know what you don't know. So then you're going to run into more issues because you don't have the advice around you.
Yeah, that's actually really smart, John. I don't think many people actually do what you just said, because they will get into it, friends and family get into an area, they talk about, this area is growing, etc. And, property, with property, it is very important that you make the right decision, because it's such a large purchase and such a costly purchase. On when you get in, the entry cost of stamp duty, a whole lot. You can't just go, oops, I made a mistake. Tomorrow I sell and I'm okay. I might lose $1 or $2. And that's not the case with property.
And, I think, one of the things that is tricky with a property portfolio is, if you see like a market correction and for whatever reason you've got some ability to forecast that this could be a, 6 month or 1 year or 2 year or 3 year kind of downward slide, that's not a great time to be selling your property. So even if you're like, actually this would be a great time to get out of that one, that's a bad time to be selling. If the market's already turned, the balance of power has already shifted to the buyer before you've even got to the market. And then it's going to take you, minimum 30 days, maybe 90, maybe longer, before you can actually move the asset, during which time the market's moving even further. So it is actually it's quite easy to sell a property if you need to on the up, when things are going well and you've got the balance of power. But as soon as it moves, it's actually really difficult. So you then end up having to hold on to it usually for maybe longer than you want to, waiting for things to bounce around and come back.
Yeah. And then, of course, by the time you sell, then there's that settlement period where there might be delayed settlement, etc. as well. And then by the time you really get the money, it's months down the track as well.
Can be a while. So what, maybe Terry, I know I didn't ask this question up front, maybe I probably should have, but I'm thinking about, could you maybe just outline kind of what the thesis or the principles are behind the way you teach people to invest? And I'm interested to then think about, how does that strategy help people avoid, I guess, what you might consider, kind of wealth traps? Like, we get into these positions as founders or as individuals that can really create kind of constraint and sort of lock up our ability to move forward and keep progressing in our sort of wealth building. So I'm interested in what's the strategy, and then how does it sort of work in with helping to avoid some of those?
Yeah. Funny enough, Sean, it is ultimately in the end, as stocks and property they're both great asset classes. They're both tangible. People might see stocks as not tangible. They actually are, because in the end, they're not stock codes or stock charts. You are buying into a business that has factories, has employees, churns out profits, etc. And they make the products that both you and I use, from the Apples to the Microsofts, for example. So from that point of view, it is important that, people and business owners see them as quite equal. They're just different asset classes. I think the biggest thing, though, is that in terms of how we invest, it's actually very similar, because as property, when you're buying a property, what you don't want to do is, obviously location, yes, that's one thing, but you also don't want to overpay for it. So that's why people generally, you want to avoid auctions where you're fighting against, someone else who's so emotionally charged and they want to buy at whatever price to live next to their parents, etc. And then you accidentally overpay. Stocks is exactly the same thing. Won't have the emotional charge though, because obviously stocks, it's very different, because you're not moving into a place, there's no emotional from that point of view. But in the end, it's all about margin of safety. So that point is very because you are trying to buy something that, for example, a property is worth $1 million. You don't want to pay 1.2, 1.3 if it's only worth $1 million. What you want to do is, hopefully there's bad news in actual fact, buy on the downturn and pay 800, 700, for something that is actually worth 1, or down a track might be worth 1.5 down a track. Yeah. So stocks is no different. It's the same thing, that if a stock's worth, let's say, $100 for the share, but what you don't want to do is overpay for it. And if you value it and it's worth only 100, you don't want to pay 120, 130, because you've paid for the future growth. What you want to do is, like property, you want to pay at a discounted rate, 70, 80, and preferably even with stocks, you can actually sometimes get that even at 60% of what it should be worth.
Yeah, right. Yeah. And so how do you teach people in your programs to do those valuations?
Yeah, it's not that hard, because with stocks, especially US stocks too, it's very transparent, because all the numbers are there, even Australian stocks, because it's the financials. And people, there are multiple methods of valuation, for example, but what's important even before valuation is looking at the quality of the stock, i.e. do they even have a history of earnings? So, we don't want to look at that stock chart. We actually want to look at the stock as a business and look back at least 5 years of data. So that's why I'm generally not drawn to people go, are you participating in that IPO, that float, etc. I will if there's a history, but if they've only been around, they're a startup and they're now listing 2 years later and they've never made a profit, I'm not interested. Yeah, I'm not interested in blue sky. I want the history. So we want that 5-year plus history, and generally, if better, even 10 years of history of financials. Yeah. And if they do go for a float, if they've got a 5-year plus history as a private company and they've got good numbers, then great. Give me the numbers. Let me put it through the model. And I want to make sure that is it actually worth that much? Baseline, it's the future, the growth, but also more importantly, I think, the financials does tell the history of a company, how have they actually been well managed, so to speak. So that's what I do look at. And by utilizing that, you'll easily get a good indication of this consistency, but also the growth factor. Have these numbers actually grown over the past 5 years, for example?
So what I'm hearing there in terms of principles is, number one, you're getting people to think about the fact that they're actually buying into a business.
Yes, they
So in
are.
the same way as if you were acquiring a company, you'd look at the last 5 years worth of financials and you're going, okay, well, do they have earnings growth? Like, is the EBITDA growing on a dollar basis? Is it actually improving in terms of overall margins? What's the revenue growth like? Like, what's the quality of the management team? Like, you're actually looking at the business as a whole business. So are you providing for the people that learn how to trade through you, like some kind of a valuation calculator or something that is
Yes.
already like doing the work for them on making these valuations, saying this is actually worth $110 a share, but it's currently trading for 100. This might be a good time to buy. Is that part of like what you are
Yeah. Yeah,
providing?
we teach how to obviously the foundation, why we do this. That's the important part. But then we do have and we have built tools like the valuation calculator that we do have built and you download. And I've taught what numbers to actually put in there, and where to actually even get this data. But then on
Yeah.
top of that, what I do know is that people are generally quite, especially if they're new to this, they're not familiar. So what I do also do is I just show you where I'm putting my own money. So, for example, I don't say, "Oh, Microsoft's great." That's one thing, but I believe what's more powerful is if I see, say, like Nike, they've dropped quite a significant amount, as of this recording, and they've had amazing growth rates over the past, and because of all these tariff, that's happening at the moment, it's been really sold down. They've got a history. They're obviously a dominant player in the sneakers market, the sports apparel, for example.
Mhm.
So we had the calculator, but more importantly, though, I share with you what I'm about to buy and why. And what I do want to do is have, say, our students physically also do the same work, at least check into it. It takes them seriously a couple of minutes. And
Yeah.
once they're comfortable, then they see me buy. I'm literally helping them build their portfolio while I'm building my portfolio. So we literally got to buy the same stocks together
Yeah.
on the same day. So then that way, your portfolio, not right away, but over a 6-month, 12-month period, there should not be too much difference in the portfolio composition of someone who's been with me. Of course, the only difference is probably size, but apart from that, they'll probably own the same stocks.
In terms of your style, because I think this is one of the things that I thought was so unique about you, you are sharing your actual numbers. So you're not just saying, I'm buying this tomorrow. You're actually sharing your portfolio numbers
Oh, yeah.
as we're agreeing, correct? Yeah.
Yes, yes. I show what I'm about to buy, what I'm about to sell, and it doesn't mean that I'm selling tomorrow. It means that during this week, just prepare for it because there is a time period. Even though my reports go out, it's not that you just got to take. It's not. I'm not day trading. I am investing. Even if we had the word trading, we generally hold something for, on average, at least a few weeks to a couple of months. So that trading is it's active, but it's active investing. I won't say it's definitely not day trading. So it gives people the time to at least check it out. And then when they are buying, all they're looking for is the signal to buy with me. And what that is, Sean, is in the end, it's all about demand supply from the big fund managers. Because in the end, the market is controlled by these guys, the pension funds, the super funds. It is not, whether the mums and dads like us, when we buy into it, it makes no difference to the market. We're just way too small. But when these guys buy, they're buying a couple $100 million at a time. So then that affects demand, affects supply, they're selling, and we are just watching their movements. And generally, because our style, we are value investors at heart, basically Warren Buffett style. So we literally are doing the same thing as them. So if we see something cheap, they will see the same thing. And our insurance policy is that, in a way, if we see them buy, we know they're not here to buy a couple of grand. They're here to buy 50 million, 100 million. And they'll continue buying for a couple of weeks as well.
Yeah. Yeah. Got it. And so can you just talk to, briefly before I've got plenty more questions for you, but can you just talk to the results? Like ultimately people are going, okay, well, I could just put money in ETFs or an index fund and just kind of ride the market. But, if I was going to put this effort into a more active approach and kind of follow the Terry Tran sort of model of the world, how do your results compare with maybe the market movements over the same time?
Yeah, it's a big difference. And this is where I say, if someone has either no idea or they don't want to do it and they just do not want to learn at all, then I think ETFs and index funds from like the Vanguards, they're a good choice because at least you're getting a market return, even though it's average, it's fine. 7 to 8% long term, decent average, and at least you're growing and doing something with the money rather than leaving the bank and earning nothing. But if you're putting the effort, for example, a passive portfolio, choosing the right stocks to make up your own fund, generally it's between 10 to 15%. So it's almost at least 20 to 50% more on the passive side. But then when you don't mind spending a bit more time, and I'm talking about, when I say a bit more time, I'm talking about 20, 30 minutes a day on average. Now we are going towards that 15 to 20% per annum. So it's a
Right.
big difference. And it might not sound like much in that 1 or 2 year time frame, but over a 5, 10, 15, 20 year time frame, it's multiples of the original capital that you bring to the market as well.
Yeah, there's a gigantic difference of investing over 10 years and getting a 20% return, getting a 7%
Yeah,
7%
yeah.
return. Like the
Yeah, and
numbers
just give
are.
you another example too, Sean, is like, because we're quite if being active, it gives you an advantage to also not be in the market. For example, like ETFs, right? If you invest in it, you have no control. Even if you see there's something wrong, the only thing you can do is sell the entire ETF and just get out of it.
Yeah.
But you have no control within the ETF to get out of certain stocks or get out of certain industries, etc. They do what they do based on the index. And then, of course, if the market tanks like it has recently, you'll tank with it. And you've got to be okay with that. But being active, for example, if we see there's a problem, we do not mind seriously going to 80, 100% in cash if we require, because I also see cash as a powerful position, because then when the market like a GFC or COVID tanks, what we want to do is have a lot of cash to then go up and pick up all the bargains as well.
Yeah.
Now, and then return wise, just to show you the difference, someone asked me that exact same question. So what I did, I just posted up the last 3 to 5 years of data of my own account, literally. So, for example, last year, I think the last few years before all these tariff issues happened with Trump and the market started tanking, the market actually did quite well in the last 2 years. Like the market, I believe, was 25% for last year. We had, when markets do well, we keep pace with it, but we don't outperform dramatically. So we had, I think it was 28.5%, 29% was our return. So we did beat the market, but not by a lot. The previous year in 2023, I had 31.5%. The market did, I think it was 24. So we did beat it by 7 to 8%. But then the previous year, even though my return was only 12%, this is the big kicker. Because of during that COVID period, the market actually went down by minus 19.5, minus 20% basically, but we had positive 12. So that's the difference. And now we've outperformed by 32%. So it's in those times of crisis that when you outperform, it keeps the capital intact to therefore allow you to have the capital to, one, not be scared and panic with the rest of the market, but because you've sold out, you've got all this capital to then be ready for when the opportunity comes and calmly deploy the capital again to then get the method returns that you usually will not get with an ETF.
That's right. I think, if I think about every, major investor who's made a lot of money, there always seems to be like two rules. One is don't lose money in the first place, because obviously, you've got 100 grand and it drops by 20%, you're back at 80. To get from 80 to 100 grand is not 20%. Again, it's more than 20%.
Yes, 30.
It's another 30, right? So having a good downside risk protection strategy, I think, is key and is lost very easily, which is probably one of the, again, as I've mentioned before, probably one of the harder parts about property. If you're in a downturn, like usually it's a terrible time to sell, just hold on and ride it out and make sure it kind of wait until it comes back. The other one is finding the right balance of liquidity. Like having, if I listen to every investor that's really made a lot of money, who's been through a few cycles, every single one of them was like, all their money was made when markets were absolutely crapping themselves, and they were ready to buy, and they were fearless in their purchasing, and they waited till they thought that at least they were close-ish, to the bottom. Obviously, no one knows where they're at the bottom, but they would buy in the dip, and all of a sudden the returns, therefore, are massively magnified on the way back up. And so they're always making money in the bad times when everybody else is, getting scared and selling stuff off.
Yeah, and then generally, too, Sean, you'll like we've got we use data. We don't have emotion. I try to teach all our students to not be but be emotional in the market. If you're looking for excitement, you should get it somewhere else. Go on a roller coaster or something. The market should just be an unemotional beast where you're able to tame it. And therefore, when you see a potential disaster based on data that's happening, when I was still managing funds during the GFC, I was definitely early. I was about 4 months early, but I saw multiple signals telling me that something's wrong. I just didn't know what it was, but there was government data coming out saying that there's a problem. So then that's when we started exiting, and then we were definitely 4 months early. By the time we exited, people are wondering, Terry, how come you're actually sitting on like 80% cash, but 20% invested, and yet you should be 100% invested, because the market's actually still kept on creeping a little bit up further. And then ultimately in the end, obviously, as we all know, that's the market tanked. But then we had all this capital, about 85% cash ready to deploy. And that's when, being early sometimes is actually a good thing too, because then post GFC, we would have multiple 30, 40, 50% years for 3 years straight. And that would have easily caught up that little loss that, or the creep that you missed out on. And in actual fact, gone ahead while people, in actual fact, S&P 500 took 4.5 years just to get back to break even. Man, if you had all that capital, not only would you just break even, you would have done hundreds of percent in that 3 or 4 year period after the GFC, in fact.
Yeah. Which I guess it kind of shows the impact of the kind of ETF or index strategy scenario as you're riding those markets and you have those kind of major market moments. I know every data sheet that I've always looked at, it's like, well, if you look at something that's over, say, 20 or 30 years, it's a small number of days actually that if you weren't participating during that time, you've actually missed out on most of the return. Like you're taking such hits every time the market corrects that you have to stay in for a long time, whereas you're playing a much more active role. So the defense is super important. So if you think about, I know this is probably a hard question, but if you're a founder, we've probably got lots of founders listening today that are probably, mid 30s to early 60s, I would say.
Yeah.
Most of them have probably got businesses doing anywhere between maybe 2 and 30 million on average.
Yep.
What if they're in their 40s and 50s now and they're thinking, you know what, I've got maybe 15 years before I want to retire. What is a sort of balanced strategy? Are there principles in how much they should deploy to how they diversify, or what percentages they use to think about how much stays in cash versus how much is invested? How do you think about what does a sort of well-balanced portfolio look like for somebody at that stage with those kind of goals?
Yeah. So this, of course, will depend on person to person because it depends on what they already have. So, for example, we teach a lot of farmers. We are one of the biggest farming educators. And some of our farmers have literally, 30, 40 to even $100 million worth of farmland. So they are very already heavy in property, and what they need is liquidity. So I guess the biggest question that a business owner needs to ask is take a snapshot of where they are first, and do they even have any liquidity? Because what I found is if they don't, then that is where their focus should be, just actually start building liquidity. So that's the one thing. The other thing too is at that sort of 40, 50 mark, like you said, there's only 15 to 20 years worth of time left. What we don't want to do is go backwards in a big way because now we've got no time, unlike our 20s where we've got time, we make a mistake, which I've done many in my early 20s. You can always catch up. But when you're in your 40s and 50s, it's all about now risk management and not going backwards in a big way. And that's why, even though I talk about my returns, what I didn't say, Sean, is although I got that 31, 32% last year, I was only 70% to 80% invested at all times. At all times, I had 20 to 30% cash to get that return. So I actually could have gotten 40 plus percent, but I didn't want to. Yeah, because I was more conservative from that point of view because I didn't see the value anymore of the market. It wasn't as cheap as I wanted to be. So risk management is definitely number one, and start diversification and going more liquid for sure. Yeah, what I do find is that a lot of business owners, they talk about, oh, I need some big emergency fund, etc. Which I think it's good. Definitely have know what you need for your business operations. That's one thing. But sometimes what I find is they go overboard and they have too much cash just sitting there waiting for one rainy day, for example. And this is why, and I think they have that because they've got a lot of property which is illiquid. So when things do go wrong, they know they can't just sell a property very quickly and get the capital. But with the share market, you actually can. And especially if you're building a portfolio of, Fortune 500 companies, basically the Googles of the world. And if you have a portfolio like that, you don't, as a founder, you probably don't need as much capital as you think as an emergency fund, because if you need capital, literally log in the account, see, especially if you're diversified, different stocks and different industries zig and zag at different times. And if you see an opportunity to actually sell down of a particular stock and you want to lighten down, it's literally identify what the stock is, couple of mouse clicks, and it's sold. And the money, it takes a few seconds, and the money's in your account within 24 hours. So that is literally the speed of the share market as well. So what I'll say, Sean, is the balance, I would say, if you can, summary-wise, look at what you have and slowly creep up the liquidity side, the share market, if you can, but do it properly. That's important. I would say just have an overall balance because everybody's different. I can't say, oh, it's definitely, you should have 20% here, 30% there. I actually don't believe in that, Sean, because how I see things in actual fact is almost like my own share portfolio. People go, oh, Terry, should you have, 20% in banks, 20% in technology, 20% in this? I say my portfolio composition depends on what's on sale.
Good.
If there is nothing on sale and everything's expensive, I am not going to touch tech or
Yeah.
certain sectors of tech. Like people talk about AI, a couple of months ago. I missed out on Nvidia, but then because I valued Nvidia at about about $95 a share, went all the way to 150. I just could not see it worth 150, but now it's about 100. So it has come back down to my valuation. So I actually now want to buy Nvidia. So I compose it based on what's on sale.
Yeah.
And if there's nothing on sale, I would seriously rather be on cash.
Yeah.
And then vice versa, if there are bargains at that point in time, why would you not touch some more property when things are at super cheap levels, for example? But if there's nothing, then why touch that in further? Like I've got enough, then done. Then look for other markets and other sectors, asset classes that are now on sale, and then let that be the decider on what the balance should be.
Yeah, I think it's, I imagine most business owners would also resonate, like principles go so far, but the timing has to be right. And so if I think about like, a lot that I learned in doing acquisitions is, I mean, you can have all the principles, all the sort of, like if you're a thematic investor, you're like, well, we really love, healthcare businesses and aged care businesses, and it needs to look like this and look like this and look like this. That's great. But you're still not going to even if there's a great business in front of you, if the price is wrong, you're not going to buy it. Like you are not going to overpay because, as you said, you're paying for future earnings, which may or may not come. You have to make money on the way in. Like you have to, on day one, be able to get a return based on the price you pay for it, how much of the cost you think you can take out or revenue you think you can optimize. So you get an immediate return on your investment in terms of EBITDA improvement. And you're hoping, of course, that either because it's part of a bigger group or there's some exit plan, that the multiple you sell it at the end is going to be higher than the one you purchased at. So you're trying to but you have to make money on day one. Otherwise you don't buy it. Even if all the principles would say this is a great business to buy because it's got this and it's got that. I guess in the same way, you're saying don't fall in love with the principles, fall in love with the opportunity at the right price. It has to be a quality business that makes sense. It's got a proven track record. It needs to be purchased at the right time. Otherwise, if you overpay, it's the wrong purchase. Even if it's the right business, it could be the wrong timing. Like Nvidia.
Perfect explanation. Yeah, I always say that money is made when you actually get into something, not when you exit. Exit, if you buy well, you will sell well. That's just automatic. But if you buy bad, then you literally got to wait for someone dumber than you to pay a higher price now. And that may or may not happen.
It reminded me of a conversation I had with my one of my sons, who is still waiting for ANZ to get back to the price that he purchased that, so he can get rid of it. he's like, I got an ANZ at the wrong price, and until this bloody thing gets back to the price that I paid for, I'm not selling it because I don't want the
loss.
loss.
Tell him, Sean. I always say, people, it's hard to actually sell a loss. And that's the other thing. I call it zero-based thinking. If you zero-based thinking, that principle is basically, assuming whether you own or not, if you are not willing to, at this current stage, buy more of that same company or buy more of that same asset, that means you've made the wrong choice and it should not be in the portfolio. And I always say that the way you lost the money doesn't mean that you need to make the money the same way that you've lost it. You can, that opportunity cost, sell that cash should go somewhere else, and there's probably another better opportunity to make the money back quicker, and therefore you let go of a headache.
Yes. Yeah. Agreed. Yeah. There's an opportunity cost of leaving that capital invested. So I know we've probably only got about 5 minutes left, Terry, but I would really love to chat about kind of current affairs because, we're recording this in April 25. And so anyone who has, if you're listening to this in 2027, I'm sure you'll be able to look back at the news and go, what on earth happened between, I don't know, like mid-February and mid-April 2025, Donald Trump coming back into presidency and just throwing the entire US economy kind of upside down, Elon Musk, blah, blah, blah. There's been a lot of activity in the States. It's very, red wine and popcorn type stuff, but of course it's having real material impacts on discussions or disrupting a whole bunch of global norms that markets have probably relied on or are priced into kind of market calculations. What do you see as there's probably temporary impacts, and there's maybe a medium or longer term view. What's your perspective on this and how it sort of plays out, both on the pros and the cons side, I guess?
Yeah, there's a term called not just surface level thinking, but second level thinking. And this was term it wasn't invented by me. It was a really smart one of the biggest fund managers on the planet, Howard Marks, and he talks about second level thinking. And it's not just basing it on what we see on the surface headlines, but also surface what it could happen at least in the short term. So what we are seeing is definitely disruption. I do forget about each other's views, but there's definitely global disruption, and we're seeing the market react to that. Both share markets, even real estate in America, they're all dropping because of what's happened. The dollar's dropping, etc. So all that is happening. So in the short term, I think disruption was definitely happening. But I think if you look on a second level, is that what then would happen to the United States longer term? And I think a few things is happening. First is that, or the world has, through World Trade Organization since World War II, we've had an amazing time where there's been free trade, and that's allowed trade to go through, and a lot of different economies, including China, which has benefited dramatically the last couple of decades, where they've gone from poverty-stricken to now where they are today, a powerhouse on the planet. One thing, Sean, a little story. I remember visiting because my great-grandfather, and that's actually, my grandfather was born in China. Of course, he escaped the Japanese War and ran over to Vietnam during the Japanese invasion. And I went back to visit my great-grandmother back in the 80s. I was only a young kid. But back then, China was so poor that even though I was Asian, I was quite white. And people would see I'm dressed nicely, etc. And I'd have literally I'd be like the Pied Piper, a line of children just hanging around me waiting for some handout. And now these days, I'm literally nowhere near these guys. There's so many more wealthy people that, that's the last thing that will ever happen. So they've gone from where they are to where they are today. So where I see things especially on trade, is I think the destruction of not just the short term, but I think fundamentally he's potentially altered a lot of things, at least in the medium to short to longer term. Whether trade will be back to where they were, even post-Trump, is another story. I don't believe, in my view, what he is hoping for will definitely happen in a grand scale, i.e. all businesses leaving China, leaving Vietnam, and going from Asia and going back to the United States to create their manufacturing, etc. Because ultimately, in the end, Trump probably has midterm elections in a couple of years. Then he's, in 4 years' time, he's going to be out. The Nikes of the world going to spend billions and billions of dollars, knowing that short term, they have to appease him, but long term, they probably can't stay there long term anyway, because the labor cost is so much in production, and skilled labor too is so much cheaper longer term in, say, Vietnam, for example.
Yeah.
Yeah. So I think
Absolutely.
from that
And it's also completely at odds with his immigration policy because,
exactly.
how many of the Americans are going to do the work in these factories, and all the people who are willing to do the work are currently
Have now been
shipped out of the
deported.
country.
Or too scared to get out on the streets because they might be deported.
Oh,
Yeah.
it's crazy.
Yeah, it's just a big mess. I think in the short term, it's definitely a big mess. What I do see is that as long as he's in power, I think the United States has lost a bit of, especially with their allies, has lost a bit of, definitely a big trust factor, because, that saying, it takes, decades to build reputation, but seconds to lose it. And I think he has done that because, the words of the United States is no longer as powerful as seen as ally to protect them, to ensure stability in the planet. It's not happening. And they're now cozying up even towards, one thing that we would never have thought about. They're now cozying up, different countries cozying up to China and finding another ally within China, which a year ago, nobody would have dreamed that would ever happen.
I think it's it's an interesting time in the world. I've seen Europe very quickly go, all right, well, we can't trust the States anymore, so we better actually start building our own military. We've been relying on the States forever. Okay, we'll better start jacking up defense spending. They're all, there's going to be new conscription rules. People are going to be brought into the armies in these countries. Like it's a real material change as a result of how unpredictable the US has been in the sort of, the deal making. And so, people are going to make their bets where they've got some level of certainty. And so, it's an interesting change of world. But I guess, going back to your earlier point around cash liquidity, it's created some turbulence in markets, which has created really interesting buying opportunities. Where all of a sudden things are taking a temporary, hopefully temporary, short hit. Great. Some of the prices are coming down, like your NVIDIA example.
Yeah. And I mean, at the moment, it's all about the news between US and China. And, China has blatantly come out and just said that, we're going to see this till the end. And they actually do have
Yeah.
a lot of power as well, because, of course, sometimes I think Trump forgets is like, it's not just the trade on one hand, but also, obviously it's damage on both sides. But,
Yeah.
Chinese does provide a lot of cheaper raw materials to the United States to do to manufacture their goods, for cheaper goods, products, but also at the same time, the rare earths, I believe the number was like 85% of rare earths is coming from China, which the United States military actually needs.
Yeah.
So you can imagine, what would happen. They've probably got a stockpile, but after 6 months, they're going to be in trouble. They're going to start running out. So what's going to happen then? So I think if, there was a Singapore government interview that I saw, and that was quite alarming, because he said, this doesn't sort of tame down a track, not just even looking at trade, that's just money and finance, but potentially global security, and hopefully not a, warfare military that doesn't escalate as well, because I think that if that goes to that stage, I think the world become a much more dangerous place too.
Yeah, I think so too.
So, so that's my short to medium term, Sean.
Mm-hmm.
Long term, I think in the end, it is just caused by the one man. It is not how I see things. It's definitely not a GFC where things were way over leveraged, banks started to fail, etc. And things could easily be reversed. So long term, I think it, just like anything, even COVID, you'll probably be a blip in the radar if you go longer term. But at least in the medium term, short to medium term, I think there's a lot of pain between not only the United States and China, but also I think collateral damage countries like ours that are caught in the crossfire as well.
Terry, I'd love to just play back a few of the takeouts, because I'm reflecting on this as a founder who's in my I don't know, what am I, mid to late 40s, 47 this year, 47 in August, and many of our founders who are listening to us, who are probably similar ages to you and I, and have got a business and are thinking about their future and how best to optimize. And I think one of the questions that you raised early was a really key takeout for me, which is, it's not a property or shares thing. They're both great asset classes. They both have real benefits. Like, there's absolute leverage in property. It doesn't move as much. So as a kind of capital base opportunity, it's a really interesting asset class, but it absolutely lacks liquidity. And so the question is like, okay, it's not property or shares. It's, what is the right balance for me? Where are my investments today? Are they all totally attached to my business? Do I also own the property that my business is in through my self-managed? Like, how much of my eggs are riding on this thing going well, versus have I considered maybe my business grows a little less fast, but I've taken a bit of a longer term view on it, but I'm actually, withdrawing more dividends, and I'm actually investing them in a way that gives me some hedge against, liquidity crises, buying opportunities. How do I, if I was going to balance my kind of illiquid, capital heavy, kind of limited cash flow kind of model to something that's got far more flexibility and more liquidity, what is the best way actually to make that investment? And so, I personally look forward to remaining engaged with you. I'm very keen to explore personally your principles and your course for my own family, because we have, as I said, we haven't spent much time really in stocks, but we've got, I think, good sort of orientation by which to follow the right kind of principles and follow a model. And I love how authentic your business is, in the fact that you are absolutely, truly showing your investments, buying and selling, your portfolio, exactly the movements. And I think that probably is one of the things that's so unique about the way you're doing your business. And I'm sure everybody would hear the authenticity in your voice. There's plenty of snake oil salesmen in all things investments, in every asset class of investments, doesn't matter where they are. And it's always really nice to find somebody who's down to earth and genuine. So thank you very much for all the sharing that you've done today, Terry. Hopefully it's stimulated some questions or some inspiration or some real, some deep reflection and consideration for our audience. If people wanted to learn more about what you do or get connected with you, where would you direct people to?
Firstly, my website, actually, there's a lot of free resources, where one of them is even the 10-step stock checklist, where the key criteria is like of an annual report, which is hundreds of pages sometimes, and what are the 10 numbers that actually matter for a stock investment to go well, but also allows you to easily, within 30 seconds, get rid of the rubbish, because 98 to 99% of the stocks that's listed out there absolutely don't make sense and should not even be in a portfolio, and only 1 or 2% pass. So you're looking for those gems. So that free download will allow you to not only the report for you to to utilize going forward for your own investments. But also there's a bunch of videos that come along with it to show you how to use those criteria as well. So that's one thing. For those who want to go a bit deeper, there's also, we do every fortnight run a masterclass for business owners. In fact, they're in their 40s and 50s and going towards retirement and creating and sort of getting ready for that. So we run that masterclass online, and it is almost like a workshop where I teach, but more importantly, after I teach, I actually want you to do. So I literally have you do exercise so you know how to utilize these principles to physically do it, and then realize that it's actually not as hard as you think it is as well.
Yeah.
Yeah. So I've got that. So I can share that link all those links as well, Sean.
Okay, brilliant. That sounds great. So yes, we'll include that in the show notes for everybody.
Yeah.
Folks, if you've been listening today, I really hope you've enjoyed a sort of free-ranging conversation that Terry and I have had. Obviously, check out his website if you're keen to know more. And we both wish you all the best in thinking about how you build wealth outside your business, because it is an amazing vehicle for generating income, but you shouldn't have all your eggs, ideally, at this age, all in one basket with uber concentration to some future event that you're hoping for, which may or may not occur. If you're thinking that the only way for you to build material wealth is an exit, they're not always easy to do. They're not always hard to manufacture. Sometimes the timing's wrong. Things can go wrong in your business. Like, lots of things can happen that prevent you from doing that. Where possible, if it's not a kind of negative cash flow, SaaS, revenue multiple kind of business, and it's a traditional services business or product business, and it's earnings focused, maybe have a think about how much, if you were actually to start create a dividend policy, how much could you actually extract from the business on a yearly basis? Maybe you're slowing the growth a little bit, but you're actually starting to build your personal wealth in the background. And then where do you want to invest that based on your current situation? This could be an interesting thing for you to explore.
I think most importantly, Sean, is for them to not get scared of this new asset class that they may not have explored. So basically get the education, like literally understand it so you know what you're doing. So get the right education from the right person, whoever that may be. It may not be me, and that's okay. But also when you do get started, to also start small, like anything, get used to it, understand what you're actually doing, and then start scaling. Whether you've got hundreds of thousands, doesn't matter. You should always start small. And I'm talking about 10, 20, 30,000. And that's the one thing that the share market does have the benefit, is that you actually can start small. You don't have to have hundreds of thousands and borrow hundreds of thousands from the bank and literally have $1 million portfolio from day one. That won't happen with the share market. So that is the other thing too. And and scaling, Sean, is the easy part. It's getting the knowledge and knowing what you're doing, getting comfortable. Give yourself that sort of that maybe 6 to 12 month time frame to know what the hell you're doing, and then from there you'll feel so comfortable that you will scale like no tomorrow. And I've got 700 Aussie farmers now that have done the same thing and doing exactly what you said, Sean. Where as a business, farmers do have tough. Unlike traditional farm businesses. They've got other factors like, the rain, weather, etc. So they need to have this secondary source of income in case things go wrong. And this is exactly what he actually does provide.
Brilliant. Thank you so much, Terry Tran, for your time today. I look forward to remaining connected. And folks, look forward to speaking to you again in a couple of weeks' time. Thanks very much,
Sean.
Terry.
Thanks, everyone.